Good afternoon, everybody. Right. So this is the second time I present at this show, and I think it's really important just to kind of gauge the audience and to see what you're currently investing in and kind of really pitch it at the right level. I'm going to ask a few questions, and just by a show of hands, if you can raise your hand and let me know, that'll give me a better understanding. So how many of you are currently investing in stocks and shares? Raise your hand. Okay, that's about right. How many of you invest into funds, mutual funds? Raise your hand. Okay, cool. And how many of you invest into exchange-traded products? Okay, interesting, right. And of those of you who invest in exchange-traded products, how confident do you feel that you understand what you're investing in? Okay. And of those of you investing in stocks and shares, how confident do you feel that you're investing in? Okay, a little bit more. And mutual funds? Okay. My next question is this. How many of you believe that active fund managers actually outperform what they, the index, let's say a FTSE 100, their benchmark? How many of you actually believe that they're outperforming and they're actually giving you value for money? Raise your hand. Okay, perfect. Okay, so now that we've gotten through that, I have a better understanding of what you guys are thinking or potentially could be thinking. Right, so let's start. These are our learning objectives for today. Okay, so who is ETF Securities? We are not a broker. A lot of people have said, oh, are you the broker? No, we're not the broker. We're actually a product provider. We create exchange-traded products. And I'll give you a little bit of an introduction into who we are, what we've done since when we were established, what our AUM is. What are exchange-traded products? Again, I will try and make this as simple as possible. What happens is, as product providers, we work with these products day in and day out. We know them inside out. We use a lot of jargon, and we think that everybody else should understand it the way we do. And understandably, it's not that easy. So I'm going to try and make it as simple as possible. Why you should use ETPs as building blocks of a multi-asset portfolio. So multi-asset, that's the key there. Why should you be thinking about multi-asset? Why not just invest? Usually people go into just equities and bonds, bit of cash, pretty straightforward. So why multi-asset? Why is this important? So we'll talk a bit about that. We'll talk about commodities as an asset class, so diversification, and foreign exchange, very briefly. So I've got 30 minutes. I will try and make this as easy, as simple as possible. But again, you can ask me questions at the end or come back to the stand. There's two of us at the stand. Right, so who is ETF Securities? So our chairman, we're an independent exchange-traded product provider. Our chairman launched the first gold ETC, okay? So in 2003, with the World Gold Council, our chairman said, how do people have access to gold? Okay, there's nothing really out there. You have to do it via future, or you have to actually go out and purchase gold bars. So he said, I know, I'm going to create this product. So in 2003, he created the first ETC in Australia. He then came over to the UK in 2006 and did exactly the same. And the company was launched. He then continued to say, right, commodities is an asset class. There's not very many out there. People aren't actually investing in commodities unless they're doing it via futures or spread betting or anything like that. So he said, I'm going to create these various commodities. So at our biggest point, when the gold price in 2013 was at its highest point, we had 32 billion under management. Obviously, gold has tumbled, commodities have tumbled, and so on and so forth. So now we're at $15 billion under management. Okay? We have over 300 exchange-traded products, and I'm going to make that a very clear difference between ETP. So you're going to hear a lot of ETPs, ETFs, ETCs, and ETNs. I'm going to try and clarify that for you, because I've had a lot of questions on that. And because we are independent, we have various partners. So we partner up with Bank of New York Mellon, HSBC, Lombard Odier, and the World Gold Council. We don't have any ties to anybody, okay? Which makes it quite nice for us because we just don't feel like we have to go with one counterparty or one investment bank. So our product offering, commodity ETCs, which is diversified. You have baskets of ETCs, so you can get a full diversified portfolio of ETCs. Precious metals, so that's gold, platinum, silver, palladium, agriculture, and I'm talking about wheat, corn, soybean, cocoa, sugar. Industrial metals, again, copper, tin, aluminum, zinc, energy, oil, Brent, WTI, and livestock. We've even got lean hogs in there, so an interesting one, you can imagine. Currencies, we've got pairings of currencies. We've got baskets of currencies. So if you think, let's say, the GBP is going to go up against the G10 currencies, you can actually purchase a product that'll give you that exposure. And then we've got ETFs. And I'm going to explain that. So single country ETFs, so if you're looking for exposure to, let's say, China, you can get exposure to just the China A-shares market, or thematic, robotics, for example, infrastructure, anything like that. You can get these kinds of exposures. So that's our product offering. Right. So what are exchange traded products? Okay. They are what we call a passive investment instrument. There's no active fund management. There's not someone saying, I think that this is going to do better than that, or I'm going to constantly be trading things in and out of. It's not like that. It is just tracking an underlying. For example, I think the FTSE 100 is going to go up. So as an index, I'm going to invest in an ETF that's going to track the FTSE 100. It's as simple as that. So I'm going to get that exposure, and I'm going to get a return. I'm going to get the growth of the FTSE 100, same as the S&P, same as anything like that. That's pretty much it. So tracks an underlying. It's like a tracker fund. So if you've heard of tracker funds, exactly the same. One of the biggest difference is that they're traded on exchange. Whereas a tracker fund only trades once a day, exchange traded funds are trading all day. So as soon as the stock market opens, they're trading. When the stock market closes, they stop trading. But you can still purchase them, and then you'll buy them the next morning. Okay. They are open-ended, so we can create and redeem shares as and when we need to. Okay. There's no stamp duty on them. So these are just the basic characteristics of ETFs and ETCs. Classification. So the umbrella term is an exchange-traded product. Before, when we only had ETFs, that was it. So everybody only knows iShares ETFs, right? Because that's what we heard. But then when ETCs came into play, so exchange-traded commodities and currencies, all of a sudden you thought, okay, we need to have an umbrella term. So they're exchange-traded products. So there are various products that are being traded on the exchange. So ETFs are funds. We'll go into a bit further detail. ETCs are commodities and currencies, a bit more detail. The only one I won't really go into detail is going to be exchange-traded notes. And the reason is because there are very few of them on the stock market. And it's almost like a structured product because it's all synthetic, okay? So we won't really touch on too much onto that, but we'll do ETFs and ETCs. Exchange-traded funds, what are they? So they're eligible for SIPs and ISAs, and they're generally governed by UCITS. Okay, this is just an EC directive. There are strict rules and regulations when it comes to having ETFs, such as they have to be segregated assets. There's limited liability between sub-funds. Increased transparency. One of the key things that I tend to get a lot is, well, Liz, I don't really know what the constituents are. What are the weightings? How does that work? Active fund managers only ever tend to give you the top 10 constituents that they're holding. You don't know anything else that sits behind that. With an exchange-traded fund, you see every single underlying. So if we're saying to you, you're invested in the FTSE 100, you're going to be invested in the FTSE 100 exactly like that. So it's going to have the constituents, all 101 constituents, and you're going to have those weightings. Okay, and you'll see that. You'll be able to see that. So they have to be fully transparent. You know exactly what sits underneath it. They have diversification limits. That's one of the key characteristics of an exchange-traded fund. So diversification limits. You cannot have more than 20% into a single asset or a single company when it comes to ETFs. And there's robust risk management. So everything has to be collateralized. If it's a synthetic, we'll talk about synthetic and physical. And everything has to be, the risk management is very strict on it. Okay? Kinds of asset classes. So you get equity, again, FTSE 100, S&P 500, very fixed income. So you can get the Barclays global bond, corporate bonds, so on and so forth. Money markets, you can get commodities. So you can get a commodity as an ETF, but it has to be a diversified. So you're looking at the Bloomberg Commodity Index. So there are indices out there that give you that kind of exposure, and you can get it in an ETF format. Okay. And then alternatives. property, and so on. Okay? Exchange traded commodities and currencies. Right. Slightly different. The way they're structured is also slightly different. These are seen as debt securities. Again, with ETCs, you only have access to a single asset. Okay? UCITS ETFs have to have diversification. ETCs do not. So, they give you exposure to a commodity, single commodity. They are not UCITS themselves. So they are still governed by UCITS, but they are not UCITS. So they're eligible for UCITS type products. Okay? Again, they're eligible for SIPs and ISAs, and they're also governed by the EU Perspective Directive. What I'm going to make clear here is that ETCs, so for example, our largest product, as I was saying, was gold. It was one asset, single commodity that went in. You purchased the gold, put it in a vault, and you got back the spot price of that. Okay, that's an ETC. Currency, same thing. You think, right, I think that GBP is going to go up against the dollar, so you're investing in an ETC, an exchange traded currency, and it's just the pairing of that. Okay? So, the structure, very important, and this is key. I'm going to make this really clear because I had someone earlier come to me, where do you find this information? Where do you see if it's a physical or a synthetic? Every single product that is listed on the company website will have what's called a key investor document, a KID. And it will tell you how it's replicated, how it's produced. Two different types of structures, physical replication and synthetic replication. Physical, it's exactly what it says. You go out, so the exchange traded product provider, we would go out and we would purchase the underlying and we would hold it. And we say, okay, FTSE 100, we're going to purchase all the constituents, the weighting, we rebalance it as in, so if the FTSE 100, one company comes out, another company comes in, we do exactly that. Okay? Physically held, physical replication. Synthetic means that we go into a partnership, we go into an agreement with an investment bank. So people say, well, you have more counterparty risk, which you do, of course. Right? So what happens then? We say, Mr. Investment Bank, we're going to pay you X amount for you to give us the performance of cocoa. It's on a futures curve. So you have to remember that you're purchasing it on a futures. You're not going to get the spot price because we're never going to take delivery of it. Sometimes, some clients, some things that you need to purchase are better off purchased via synthetic replication versus physical. Again, because we're not going to store, barrels of oil. We're not going to go and put the lean hogs into a pen. So you're gonna get it via synthetic replication. You're still getting the price of that. You're still getting the futures price of it. And we're in agreement with a counterparty. It's not any more riskier. It is fully collateralized. What does that mean? Right. So we say to the investment bank, Mr. Investment Bank, we're going to pay you X amount. You're going to return to us the underlying price of these products. That's one bit. The other part is we need to make sure you're collateralizing this. So we want you to ensure that whatever sits with you is fully collateralized. So an independent, another custodian comes in and holds collateral. And this is all safe collateral. So these are bonds, gilts, treasuries, anything like that. Okay, so you don't have to then worry, oh gosh, what if the investment bank goes under? Because after 2008 and the whole Lehman Brothers, everybody said, oh, counterparty risk, we can't take any of that on board. Well, you know what, sometimes you're going to have to do that because if you're investing in, let's say, a emerging markets type product, and you look at a physical replication of an emerging markets, can you imagine how many constituents there are? Over 500. And some of them could be quite illiquid. Some of them are going to be expensive. So you'd rather do it via synthetic. You're still going to get the exposure for that underlying. You're still going to get the emerging markets, the MSCI Emerging Markets Index, but you're not going to be paying for it as much. Right? So that's why you have to think about both. And again, you will see exactly how they're replicated in the KID. The KID will tell you this is a physical replication. This is who's holding it. This is the custodian. Same with the synthetic. This is the counterparty. This is the investment bank. This is who's holding the collateral. Collateral is also important. You, as ETF providers, we have to show you what collateral is being held. And collateral is over 110% because obviously bonds go up and down. So we need to ensure that if anything ever happens to that investment bank, your money is safeguarded and we can pay you back. with that collateral. So it's over 110, up to 110% collateralized. So ETPs are building blocks of multi-asset portfolios. Right. This is just a hypothetical portfolio. And why we did this, why do we do this? Okay, so when you're out there and you're saying, okay, I'm going to use 5 different fund providers. Let's say active fund managers. By the way, this isn't anything between active versus passive. It's about how you get the most bang for your buck, really. If you're investing in an active fund manager that's saying, right, I'm going to look at the UK equities market, he could potentially do well. But if equities are doing well anyway, what's the point in going to an active fund manager when you could have just gone into a FTSE 100, right? I mean, we saw what happened 2 weeks ago, right? And some of these active fund managers, they didn't suspect it. They weren't saying, oh yeah, I'm going to take it out of here, I'm going to do that. It went up, it came down, exactly the same. So what's going to happen at the end of the year when they're going to come back to their investors and say, well, you know, we had those 2 weeks or 3 weeks where the FTSE kind of plummeted a bit. We were invested in some of the wrong companies. Well, you know, I'm paying you as an active fund manager a premium to ensure that you know. No one knows. So something like the FTSE 100, UK equities, it's much easier. So you can build your own multi-asset portfolio, right? You can say, I'm going to put 50% into equities, FTSE 100, S&P 500, emerging markets. I'm going to do some in fixed income. Again, like I said, Barclays, global bonds, corporate bonds, anything like that. Some commodities, 10%. By the way, 10% is quite high in this scenario, but some people tend to look at 5% to diversify your portfolio. And then currencies, about 5%. Again, diversification. If you've got USD, then you're going to want to make sure that you're hedging yourself against that USD depreciation potentially, right? So what you're doing is you're diversifying your portfolio. You're building it with various things. You're putting some treasuries, some commodities, some oil, some gold, and so on. And you can do it all potentially under 1.5% of the total cost, annual management fee. Some active fund managers will charge you up to 2%, 3%. Will they outperform? Could you do the same? It's all dependent, right? This is just an alternative. What you could also do is say, right, I'm not going to have the expertise into the emerging markets So I'm going to say I want a FTSE 100 and use my premium to go to an active fund manager for emerging markets. That's the diversification. So it's really a combination. It's a blend. It's a blended approach to use exchange-traded products. Kind of what we were saying, strategic versus tactical. One of the nice things about exchange-traded products is you can purchase them as and when. So if you have a view, I have a brilliant example. I tend to work mainly with IFAs and discretionary fund managers. And I had a discretionary fund manager call me up and say, Liz, can you come and see me? And I said, well, I tried to see you in June, and you said, you know, commodities weren't your thing. He goes, yeah, but I've got a client. This is 2 weeks before the equities market came down. He goes, I've got a client, and he's really interested in commodities. And I said, oh. He goes, I just don't know enough. I don't know enough to actually advise him on what he should or shouldn't invest. He goes, can you come and see me? And I said, well, I can't see you tomorrow, but I can go on Monday. He's in Birmingham, by the way, so I had to catch the train and all of this. And I thought, brilliant. So I'm like, I know how the products work. I don't have the research. I had to get my research guy to come with me, and he's looking at me, Liz, really? And I said, look, he's really keen. His client said, I have got X amount of money, and I want it out of equities now. I want it to go into commodities, but I don't know which ones or how or anything. So I said, fine. So we went up there. 2 weeks later, what happened? The equities market went down. We've seen the price of gold go up slightly. We've seen the price of silver go up, platinum, and he was like, how did he know? Well, but this is the beauty of exchange-traded products. You can do it as and when. You don't have to wait. You're not paying a premium for it because they're on exchange. Okay? So it's about a blended approach. It's about complementing exposures through active managers. You know, you can respond to macro surprises. Someone can say, actually, I want to come out quickly, or I want to go in quickly. It's all dependent.
So did you find out how he knew?
You know what? That was an interesting one. No. I don't even think the fund manager knew, because he was just like, I can't believe, 2 weeks before, literally 2 weeks before. And it was quite a chunky amount of money that he was looking to invest in commodities. He just thought, which, you know, it's about investor sentiment, right? equities markets have been in a bull run for quite some time. Let's think back to 2008. Did anybody think that the equities market was going to drop the way it did, or anything was going to happen? Not really. But it's a cyclical market. The reality of it is, it's, what comes up must go down, and eventually, it's that kind of sentiment. And some people just look, and it's also a 7-year cycle. A lot of people tend to say that equities markets tend to have a 7-year cycle. So after 7 years, then we're coming up to 7 years, something has to happen. And we've had a lot of geopolitical issues at the moment. So kind of gives you that. Oh, gosh. Right. This is a perfect example. It's one of my favorite slides, and I always like to talk about this a little bit because what it shows you is, back to what I was saying, what goes up must come down, diversification, and so on. So if you look at this, this is a 11-year performance, okay? This is an interesting one, and this slide was only updated on Friday, okay? So cash is at the highest. Only from Friday, though. It wasn't like this, by the way, but you can see bonds, equity. I mean, bonds, people are always wondering what's happening with bonds. What are we going to do with bonds? Equities, real estate, obviously commodities, bless them. And they've been at the bottom for quite some time. So what does that say? It's a good time, buy low, sell high, that kind of stuff. It comes back to, our own sentiments. We never feel like, oh, is it low enough? Is it low enough? And what happens? We start buying when they start to go up. And you think, shoot, I could have gotten in there a little bit quicker, right? But what it really shows you is just asset class performance is all over the place. You never know what's going to outperform what. And what you want to do is just make sure that you're diversified. Your portfolio looks diversified. Okay. So what are the benefits of using ETPs? We try and say they're simple. In our eyes, they are. We try and say, right, they're transparent, you know exactly what you're buying, they look like this, if it's physically replicated, and so on. They're accessible. You can purchase them, via any stockbroker. All of your stockbrokers will have access to them. You can see the bid-offer spread. You can see what they're doing, their performance. They're diversified. It gives you... There are exchange-traded products for virtually everything out there. And I mean everything. Occasionally, I think I've had someone call me up and say, this is the best one. Do you have powdered milk? And I thought, but he also wanted coffee and sugar. So it was those three things that he was looking at. So it's one of those things, virtually anything out there. They're cost effective. Your most inexpensive ETF, your very basic FTSE 100 ETF, by the way, it's not ours because we don't have vanilla type ETFs as S&P 500 or FTSE 100, but your most inexpensive will cost you 0.07% per annum, which is, it's hardly anything, right? They're saying in the States you can actually purchase exchange traded funds, your basic vanilla FTSE 100, S&P 500 for nothing, because of the volume, because the trading volume is so high. They're transparent, which you've talked about, and they're flexible. So you can purchase them as and when. So these are the benefits of using them. General risks. Back to what I was saying, market risk. Everything goes up, everything comes down. Just be aware that it is market risk you're taking on board. Tracking difference. Tracking difference means, right, so if we're tracking the FTSE 100, your tracking difference should only be that annual management fee. That's it. If you see a big divergence, there's a problem. Okay? Sometimes some providers do stock lending. They lend out their stock to gain more money off of it, basically. Some providers don't do any of that. Again, all of this is part of the KID. The KID has to state we are doing X amount of stock lending on these on the securities. Tax. You must get your own tax advice on this, which is something that was said at the beginning. Cost, it's understanding the costs. So, what the total expense ratio is, what your bid-offer spread is, what your stockbroker is going to charge you, if there's a cost in your portfolio to hold it. All of these things you have to take into consideration. And then currency. If it is a product that is USD and you have GBP exposure, just make sure, okay, there is a currency risk there. There are GBP hedged products. They cost a little bit more because obviously you're hedging out the currency, but they will just, they'll minimize the volatility, because what you don't want is for the product to go up 5%, but because the devaluation of the currency came down to, you're actually only up 3%. Okay? Total cost of ownership, we just talked about. So you've got management fees, administrations, index and licensing fees, and that goes back to the whole swap fee, because there's a fee on top of that. Everything has to come. Everything is always discussed when it comes to that kid. Trading and post-trading, so bid-ask spreads, trading fees, recurring, if you have a recurring, your brokerage platform. So these are just key things for you to make sure that you're aware of. So it's not just, oh, it's an annual management fee of, 0.7, but there's other small fees that might take it up to 0.10, but that's it. So commodities and asset class. Okay, back to what I was saying. I mean, you saw that graph, right? Where commodities have been all-time low for the last 5 years. Well, I can tell you for a fact that sugar is at a deficit. First time in the last 6 years that sugar is at a deficit. How come? El Nino. There's all these problems in Brazil. It costs a lot to get the plants to start working again. All of these kinds of issues then play a part in that. So, but what they do is they give you a diversification. What we tend to say is that gold, for example, is uncorrelated to equities. And so here you can see the correlation with commodities, the one-year daily rolling correlation of commodities, and why you should look at it for diversification purposes. And then commodity prices and inflation. So it's just about diversifying your portfolio. Basically, the old saying goes, don't put your eggs all in one basket. And again, with rising wealth, this is likely to drive structural increase in commodity demand. Okay, this is a bit of a questionable thing at the moment because we've seen what's happened in China and so on. But again, China's only going to be in the position that they're in for a short period of time. So is it the right time to invest? Like I said, invest while things are low. Otherwise, you'll be waiting and you'll think, oh, I could have done it, 3 months ago, 6 months ago, a year ago. So it just depends. So access to commodities through commodity ETPs. Again, we've talked about how you can access them, commodity baskets and single commodity ETCs. And then foreign exchange. This is back to what I was saying earlier about ensuring that if you've got a US denominated type product, that either you're looking for a hedged version or you're saying, okay, I need to make sure that I've got something that hedges myself against that risk. So you can have a currency pairing. So I'm going to put X amount into a GBP versus a USD, or Euro versus USD, or so on. You have to remember, it's also the most liquid market in the globe. FX is happening all the time, every day. So having that kind of an alternative asset in your portfolio might work nicely. And then just understand, well, we've talked about currency risk. So all of these kinds of things are just something for you to kind of bear in mind. So investing abroad, buying foreign retirement, using shares in US listed companies. And this is back to what I said earlier about your currency exposure. So you have a portfolio. You've got some USD-based assets in there. You can see here where the devaluation has actually happened because you were invested in a USD. The USD devalued, GBP went up, and you think, oh, actually, I didn't gain as much as I thought I should have. And then, again, currency hedged ETPs, which we talked about, single currency ETCs and currency baskets. Right, so I'm hoping that I managed to get some of these things across to you. If you have any questions, I'm happy to take maybe one or two, or you can come and see me at the stand. No? Yes?
ETPs and ETFs, how online do I know what I'm looking at? Because I've used ETFs and I didn't even know that. Do they look the same from a trading perspective, or is this actually different?
No. So ETP is literally the umbrella term that you would use to classify ETFs, ETs.
I mean, trading online, is there a ticker difference that actually shows up in the
No. It would say, so if it's a commodity, it would tell you that it's a commodity in the KID. If it's an ETF, it all comes down to what you're looking to invest. So if you've traded ETFs and you're pretty much trading, an overall index. If you're an ETC, you'll know that it's an individual asset, like so gold, silver, platinum is just a single one. But there's nothing really that distinguishes. It wouldn't. So, for example, one of our products wouldn't say. It wouldn't say ETC XYZ. It would just say ETF securities, COCO. So it wouldn't make that distinction. All right.
Okay. Thank you very much.
Just in
Liz.
time.
Thank you.